What is a debit spread? A debit spread involves the simultaneous purchase and sale of options within the same expiration date, where the cost of the option bought is higher than the premium received for the option sold. This strategy typically results in an initial cash outflow, debit, for the trader. What is a credit spread? On the other hand, a credit spread involves selling an option and simultaneously buying an option of the same type, either both calls or both puts, with the same expiration date but at different strike prices. The premium received from the option sold is higher than the premium paid for the option bought, resulting in an initial cash inflow, credit. 12 differences between debit and credit spread. 1. Direction of cash flow. Debit spreads result in an initial cash outflow, while credit spreads result in an initial cash inflow. 2. Market outlook. Debit spreads are often used in anticipation of a significant price move in the underlying asset, while credit spreads are more commonly employed in stable or neutral market conditions. 3. Risk and reward. Debit spreads offer limited risk and potential reward, while credit spreads offer limited reward and potentially higher risk. 4. Profit potential. Debit spreads have a higher profit potential if the underlying asset moves significantly in the anticipated direction. Credit spreads have limited profit potential based on the premium received. 5. Strike price placement. In debit spreads, both options typically have the same strike price. Credit spreads involve different strike prices for the options bought and sold. 6. Break-even point. Debit spreads have a lower break-even point due to the initial cost incurred. Credit spreads have a higher break-even point because of the initial credit received. 7. Time decay impact. Both strategies are affected by time decay, but credit spreads may benefit from time decay more than debit spreads due to their initial credit. 8. Volatility impact. Debit spreads may benefit from increased volatility, while credit spreads may suffer due to increased volatility. 9. Strategy purpose. Debit spreads are often used for directional bets, while credit spreads are employed for income generation or hedging purposes. 10. Margin requirements. Debit spreads might require higher initial margin due to the cash outflow. Credit spreads require less initial margin due to the cash inflow. 11. Probability of profit. Credit spreads typically have a higher probability of profit than debit spreads, but with a capped maximum gain. 12. Closing positions. Debit spreads are closed for a debit, and credit spreads are closed for a credit. Conclusion. Debit and credit spreads are distinct options trading strategies, differing in their initial cash flow, risk-reward profiles, market outlooks, and purposes. While debit spreads are employed for directional plays and potentially higher gains, credit spreads are used for income generation or hedging with a higher probability of profit but limited potential rewards. Understanding these differences is crucial for traders to select the appropriate strategy based on market conditions and their risk tolerance.